Wow.
There we go.
All right. So, of course, thank everybody for joining us during this very, very busy and difficult time. I was thinking that maybe we should have done this on Zoom. Last night I attended a Zoom meeting for a wonderful Yale client who's receiving the Yale Gold Medal Award, and they had it on Zoom, and you could see everybody's beautiful decorations, and it was very warm. But tonight we'll just keep it informal, and maybe Dave, for our January knowledge series, we can do it on Zoom and have like the French Alps in the background or something to make it seem
I'll
nicer.
get that green screen on order tomorrow. Okay.
So on the one hand, this conversation about charitable gifting could be considered a little late, given that the year end is only 22 days away. But on the other, it could be perfect timing if it gives you the impetus to do something productive that you may not otherwise have done. And there is certainly more than enough time for any possible charitable gifting strategy to be put into play. Before launching into some of the important detail, I want to identify two of the essential validations, if you will, for including a charitable gifting plan into your personal financial plan. And number one, we are in a time of unprecedented need, and none of you need me to tell you why that is, but these are not my words. I was really pleased that while on a tax strategy conference call with the Schwab Advisor Services, the tax consultant led with this point rather than focusing first just on the financial gain to the donor. And we are indeed in a time of unprecedented need. The second is that the charitable tax deduction is the most important deduction not to be lowered or eliminated in the Tax Cut and Job Act of 2017. So if you remember, and for whomever this applies to, they put a cap on the state and local taxes and eliminated some other deductions, which just made it harder to itemize. And the standard deduction for, well, let's go forward and say the standard deduction for 2021 for married filing jointly has been raised to $24,800, which is nice, but itemizing deductions above that level would be better, would be a great tax savings. In fact, they even went as far as saying that the maximum allowable charitable deduction was raised to 60% of your adjusted gross income, up from 50%. And admittedly, not many people do that, but if you were so inclined, it just shows that they support charitable gifting as a deduction. So, okay, our conversation tonight will focus on three primary strategies, and they each have a name, but I want to first label them in terms of their distinctly different financial objectives. So the first is gift now with simple gifts. The second we'll be discussing is gift over time and or more frequent gifts. And the third is give and earn income back. So those are the three. Gift now with simple gifts is just direct charitable donations of cash and securities, cash or securities. Gift over time and or more frequent gifts is the use of a donor-advised fund. Gift and earn money back is the use of a charitable remainder trust, also known as a CRUT or a CRAT, is silly acronyms, which we will define a little bit later. So let's begin with the direct charitable donations of cash or securities. It's a simple and well-known technique in which you send cash contributions or publicly traded securities directly to a charity or charities within the calendar year. And most of us do this, at least on an on-request basis. You know, you get all the phone calls. But I want to touch on a few important aspects or strategies related to these simple direct gifts. There are many well-intentioned folks that have a commitment to annual gifting, but are not actually benefiting from any federal income tax savings. And there is a way to remedy this other than just giving more. But before we explain, remember two things, just as a backdrop so that it makes sense in a minute. The standard deduction for married filing jointly again is $24,800. So if you are to achieve a higher deduction, your allowable itemized deductions must be above $24,800. Additionally, state and local taxes are, again, capped at $10,000 now. So even if your state income and property taxes well exceed that, you can only use the 10. So needless to say, charitable deductions have now become much more impactful in terms of tax saving strategies. So enter the idea of bunching. Bunching is a strategy in which you double your regular giving in 1 year to hit a level that allows you to take itemized deductions that exceed the standard deduction, thus generating a much higher level of tax savings. And in the subsequent years, you skip your regular giving and simply take the standard deduction in that year. So continuing your giving in this pattern benefits you by maximizing the tax benefit of your generosity. So I'm going to give you an example. It's sort of true, sort of not true, but my wife and I, Pamela and I, have about $30,000 a year in state income and property taxes, but we can only use the 10. So we start there. Then we add on a little bit of mortgage interest, and that gets us up to about $16,000. So that's our base. And over the last few years, we've gifted a consistent $7,000 to $8,000 in charitable donations per year, church, alma maters, and such. But that brings us up to about $23,000 to $24,000 total. And given that it is annoyingly below the $24,800 standard deduction, we are not harvesting any additional income tax savings from our charitable gifts. And if I continue to do it this way, then that will persist. But instead, if we were to double up this year and gift $16,000 instead of $8,000, then we'll have $33,000 in itemized deductions, well above the standard deduction, generating about 33% more tax savings just from deductions. And next year, we don't gift, just to kind of restock, and simply take the standard deduction, which is where we would have been anyway, or where we have been over the last few years, even while being charitable. So, bunching. And we'll come back to that. I don't know who came up with the term, but it seems to fit. The second nuance is this. If possible, and everybody knows this, but it's better to make your direct gift with appreciated stock, which can either just be shares that you hold in an after-tax portfolio or corporate stock grants such as non-qualified and incentive stock options, ISOs. The reasons for this are A, the terrific leverage of getting a full charitable deduction on a gift for which you only invested a fraction of its current value. Like, for example, gifting $10,000 of Apple stock with an investment basis of $4,000, if you're so lucky, your deduction will almost be as much as your original investment. And B, you avoid paying capital gains tax on that appreciated gift, which you might have if you'd sold it one day, and that capital gains tax savings could augment your gift by 50 to 20% depending on your tax bracket. So, direct annual gifts are great. Everybody does it to some extent. But it is a one-and-done transaction, and frankly, some folks feel uncomfortable setting expectations by any one 501c3 organization that they should expect an annual gift. So this brings us to the donor-advised fund. As a quick tangent and as a reminder, just so you know, the recent CARE Act has given each individual that does take the standard deduction and what they call an above-the-line $300 deduction for charitable gifts or $600 deduction for married filing jointly. So if you do take the standard deduction this year, you'll at least get that small charitable deduction. Anyway, back to donor advised funds. The donor advised fund is a wonderful tool, and this is how it works. The donor advised fund is itself a registered charity, a registered 501c3. Just as direct gifts, you make a charitable donation of appreciated stock or cash to the donor advised fund. In doing so, you secure a potential deduction for the fair market value of the transfer on that day. And just sticking with the appreciated stock approach, the donor advised fund sells the appreciated stock. You pay no capital gains tax on the sale. And the proceeds of the sale are invested into a well-diversified portfolio of no-fee funds with the objective to grow your donor advised fund balance over time. So while you do secure the deduction in the year of the transfer or in the year of the funding, you have essentially an unlimited amount of time to make those gifts to selected charities as you see fit, almost in perpetuity. The pros to the use of a donor advised fund are that A, you create one deduction, but you are not locked into one charity. Your gifts can be made to any number of deserving charities. And B, the growth of the underlying investment asset gives you a really nice multiplier on your charitable gift, such that you could ultimately pay out $14,000 of gifts for your original $10,000 investment into the donor advised fund. I mean, I've seen some as much as double. If people gift a little bit at the beginning and then the assets grow and they gift a little more and the assets grow, I've seen people who pay out twice as much as they invested. So you get that multiplier. Logistically, the Charles Schwab Donor Advised Fund is very well run. There are no fees. It is internet-based. You have a personalized dashboard on which you go in, select a charity from the drop-down list, and they have all of them in there. You make the grant. You write a personal note if you choose, and Schwab takes it from there. They send it out. They take the records. They give you the tax receipt for it. Lastly, the same strategies that were discussed in direct gifts apply to the donor-advised fund approach. You want to be gifting appreciated stock. It's far more productive. And you still need to think about bunching. Bunching may be necessary to secure a high level of itemized deductions. You can't itemize just because you use a donor advised fund. You have to put in enough that gets your total itemized above the standard deduction. There are other donor advised funds. We've worked with Fidelity, Vanguard, even some universities have their own donor advised fund. But Schwab has been wonderful. And if your capital accounts are already at Schwab, it's just easiest to use them. Also, they have a department that if you do have corporate stock grants, particularly restricted stock units that are highly appreciated and it would all be taxable as income, Schwab could work with that company's custodian to transfer those shares over. Excuse me. As a quick aside, this will be really quick, some folks have asked us whether it would be better or not to establish a foundation rather than using a donor advised fund, and our default answer is due to the complexity and the cost and the possibility of the next generation wanting little to do with the foundation. We kind of say at $5 million or below, you're better off with a donor advised fund. Over $5 million, it's a strong idea, and of course that doesn't come up every day. A private foundation is just a charitable organization, usually founded by an individual or a family with an initial gift and managed by its own trustees or directors. People like it because family members can be involved and actually be paid for service on the foundation, and foundations can make grants to more than 501c3 organizations, like they can gift to educational, religious, or other activities that serve the public good. Foundations are in perpetuity. They have to pay out 5% annually. So as long as the entity is alive, even for multiple generations, it has to be managed, which is why you get that execution risk. But that's a little bit about foundations. So moving on, both the direct gifts that we spoke about and the donor advised funds are gifts that only generate tax savings back to the donor, and that is a fine thing. But now we'll turn our attention to charitable remainder trusts, which is an instrument through which gifts are made, a current tax deduction is created, but in addition, an income stream is generated and paid to the donor over his or her lifetime or a joint lifetime. The scenario for which a charitable remainder trust is particularly productive is the individual who holds a generous level of appreciated assets, is well developed in retirement assets, pension, and Social Security, and that the primary investment objective for at least a portion of the assets is simply a spendable income for your life. So you know you want that anyway. The charitable trust supports that investment objective. So this is how it works. You open the charitable remainder trust with a retail trust company, or in limited cases, your own attorney. You transfer appreciated stock to the trust. And as a substitute for stock, you can also use corporate stock grants, collectibles, art, real estate, a few other things. The trust company sells the gifted asset, and you pay no capital gains for that sale. The proceeds are invested into a well-balanced investment portfolio. You select an annual income stream that will be paid to you on an annual basis, typically paid out on a quarterly distribution. The income stream, the choice of what yield you're going to get on that income stream is somewhat up to you, meaning that you can pick it, but it has to be consistent with reasonable investment yields available out in the market. And when you pick your income stream that you want coming to you, it can be expressed either as a fixed annual yield or a fixed annual percentage of the account value. If it's the former, you have what is called a charitable remainder annuity trust, or CRAT. If it's the latter, you have a charitable remainder unit trust, or CRUT. So then you designate one or more charities that are your final beneficiaries. Once it is a completed gift, and it is an irrevocable gift, then you get a current year tax deduction for the present value of the future gift. And the future gift is the value of the account when the donor passes away, and the balance that's in the trust is sent to the named beneficiaries. So using a calculation that incorporates your age, the level of income that you choose, a future, the present value of that future gift is calculated, and this becomes your monster current year tax deduction. And if it's more than what you're allowed to take according to your adjusted gross income, the excess deduction can be carried forward. As one additional benefit for whom this may apply, the gift to the irrevocable charitable remainder trust removes that asset from your taxable estate, if that is important to you. The nuance to this very powerful gifting tool is that you have to balance the amount of income you would like to target with the desired level of tax deductibility and the preservation of the value of the future gift that you want to leave. And unsurprisingly, when you set up this mechanism, the more income you take and the earlier you begin taking it, the lower is your tax deduction. And the lower the income stream you take and the older you begin taking it, the higher is your tax deduction. So you kind of have to balance these considerations to figure out what is best for you and when it's best to put it into practice. And you can establish your charitable remainder annuity or unit refund payout on one life or two lives with a spouse, just like really any corporate pension would do. So let me close out that part by giving you a quick example. So you're age 60. You fund the charitable trust with $250,000. The cost basis of that money to you is $125,000. So you're funding the trust with twice as much as you invested, which is good leverage. You, based on mortality and stuff, you have a 30-year income payment. You choose an income payout of 6%. The invested assets grow at 6%. So you, in that scenario, you will get an income of $1,250 per month, which is better than any fixed income investment you can get out at the market at this time, better than any bond, better than any junk bond. You avoid paying $18,750 in capital gains tax, and your current year tax deduction would be $81,894, which is a lot for an instrument that's giving you consideration back. If you did the same thing, but you took a 5% annuity instead of 6%, your income would go down to $1,050 per month for life, but your current year deduction goes from $81,000 to $99,000. If you do the same, but wait to age 65 to begin your annuity, then the current year tax deduction increases to $114,000. So you could just see how jiggering these different financial parameters makes a difference. So logistically, the charitable remainder trust involves more work, no doubt. You got to find the trust company, there are fees to set up the trust, and you have to figure out these financial parameters. But once it's in play and you get your check every month or every quarter, it's a nice system, and you get that for life. All right, we've covered a lot of material, but we do have one more bonus scene for you. And this is simply a reminder that anyone who currently is required to take their RMDs, required minimum distributions for an IRA, including 2020 when the RMD is technically waived, you may annually give up to $100,000 or any lesser amount to a qualified charity, and then that IRA distribution becomes non-taxable. And I won't go further into this on the call. You can speak to me individually, but we do find retirees who are over 70 and a half. They have their required minimum distributions. They're taking the full taxable required minimum distribution, but then making charitable gifts out of their after-tax checking account. So, of course, it would be better to use a portion of your RMD to send directly to the charity so it's not taxable, rather than gifting it out of an after-tax account. So just a little side thing about RMDs. So, well, this has been, like always with me, a speed version of a very important topic without the benefits of diagrams and slides and such, but my hope that this is clear and it's informative So I now just want to open it up to any questions or comments. And if you need to drop off and make dinner or whatever, thank you for your participation and have a happy COVID-adjusted holiday season. So the floor is yours. Open to any questions.
Thank you, Charlie.
Bob.
Mm-hmm. That's it. Very, very, very interesting. So thanks. We'll follow.
You bet. Okay. Any other questions? Of course, there haven't been any to begin with.
This is Carrie. I just want to comment.
Okay.
Go ahead, Carrie.
Thank you very, very much. And I really do want to acknowledge the very personal reminder I would have missed tonight, and it's very essential for our year-end planning. So I certainly appreciate it.
Okay. Thank you.
Charlie, it's Paula. I wanted to ask about the Charitable Remainder Trust.
Yeah.
Like a lot of universities have a version of that, as well as some other major charities where you do it through them. And my assumption was that they handled all the administration. That way, if you were setting it up and they were the sole beneficiary of the trust assets.
Right.
Are you familiar with that?
I am. They're typically called pooled income funds, and you see them in universities, but also other high-end nonprofits. And you're pretty much right. The trade-off is you don't have any fees because they've got the whole architecture set up, but now you're locked into the one charity, and you're locked into their investment process, which for most universities, considering particularly the high-end ones, they have more than enough well-trained CFAs to run these funds. But oftentimes people who are more proactive would like to have it held at a private trust so that they could oversee the investments. And I do know that a lot of universities have a split income payout. So that way you can get the higher deduction if you want the lower payout, and vice versa. And they have different risk levels. So you can get the income-only portfolio and you can get the high-growth portfolio. So there's a lot of merit to doing that. We have a client who did their entire charitable trust with the Colorado College, and they've generated a nice return, and I see the tax forms every year, and it's efficient. So that's an option, yeah. But on the other hand, I also have a charitable remainder unit trust where the donor has 10 beneficiaries. So,
right, yeah.
Okay, Dave, stop sitting on the keypad.
Sorry.
Okay, well, thank you. That's useful. I guess I was a little confused as to the process, because I thought that those it was all set up front based on an assumed rate of return, and that the actual investment results didn't really. I mean, that was the institution bore all the risk or got the windfall.
Well, it's more to say that you pick an assumed rate of return for the annuity payout if you're self-directing it. If you go into a Mount Holyoke pooled income fund, you don't get to choose. But if you're setting up your own CRUT, then you get to pick. And if the investment results exceed your rate of withdrawal, that when you die, the beneficiaries are just going to have a much bigger bounty. And similarly, if you're we ran across a woman who had a charitable remainder unit trust who took the big monster $80,000 deduction back in the 1990s, and because the investments didn't work out, she had only pennies left in her trust, and that does not unravel or claw back the tax deduction, assuming that you didn't do anything to impair it intentionally. So getting bad investment results doesn't invalidate the tax deduction. It just makes you regretful that you didn't donate to the charity, and when the results are better than expected, then the charity gets a bonus.
I see. But I thought that was just all actuarially determined based on an IRS table or something. I guess I just wasn't aware that this all got trued up later on at any point.
Yeah.
So, okay, that's helpful. Thank you.
Good. Thank you for joining. How's your dad?
Good.
Good.
We're having a cold streak in Florida. It's in the 50s, so.
Oh, please. Yeah.
He's suffering greatly.
Yeah. I'm reading Russian poetry right now because everything's dark and dank. But all right. Well, thank you, everybody, for joining. And as always, if you're still on the line and you want to talk privately, just reach out to Dave, and we appreciate your support. Okay?
Thanks, everybody.
Yeah.
Thank you. Bye.
Thank you.
Dave.
Thanks. Good night, all.